Hey everybody, welcome to this chapter 14 snippet. This is going to be a little bit more than a snippet though. What I'm going to be doing is showing you how to create a model for building notes, um, calculating the payments and the principal and the interest and stuff like that for a note, installment note like we did in chapter 14. And I'm going to just pull this stuff out of my brain. Okay. I'm not looking up anything. I don't know. And I'm going to calculate both a annual and a monthly amount. Okay, and so my spreadsheet's on this side over here. So when I look back here, I'm trying to just make eye contact and stuff like that. So um, we need a note payable. So we'll come up with some amount. We'll need the interest. It's going to be annual. Sorry, my computer is being crazy here. Annual interest. Number of periods, we'll call it number of years. Let's go ahead and make this a little bit pretty there. So let's start off with some amount, and I'll just say 100,000. That just seems to work for me. Let's make these dollar amounts and no cents. Because when we're dealing with $100,000, please don't, please don't. Okay, if it's gray, then you want to enter the data into the gray area. I really brain farted. I don't even remember what I was saying. But anyway, I just came up with $100,000. Whatever amount it is, it's no big deal. Annual interest, whatever it is, we can go 8%. 8%. That's fine. Number of years, let's just say 5. And then what we need to do is we need to come up with our annual payment on what we're going to be doing. So annual payment. Actually, let's just do this. Payment. Oops. Payment. Annual from the table and annual from the formula. Because I want to show you the formula too. Then I'm going to do a monthly one based on the formula. Because let's be honest with you, we don't deal a whole lot with annual payments. We will in this, for simplicity, but you as an individual deal with it on a monthly basis. If you have a loan, you're paying it monthly, not annually. So we're going to go ahead and do that. Now, I will have to look up the formula. So I have the table. It's table B3 in the present value of an annuity of 1. Now, I have on Canvas, and let me pull up Canvas for you. I was doing some homework for someone, helping them out. They never texted me back now that I think about it. So when you're in chapter 14 module, there should be the present value tables I put there for your convenience. The astute, yeah, here they are, time value money tables, solutions there. Actually, that isn't it. Well, anyway, it's in the book. Let me just click on that, see what this is. I thought I had them in here. I might be thinking of another accounting class that I have them in. Oh, this kind of goes over how to, if you have a question about time value money, this kind of is a good little exercise to do it. Bottom line is we're dealing with table 3. No, table present value of an annuity. This one says table 2. In the book, it's table B3 in appendix B. All right, so you can go there and look at it there. Otherwise, just Google present value interest factors of an annuity, and it'll give it to you, okay, B1. If we pull it from the table, all we're going to do is come over here, and the table at 8% for 5 periods is going to be 3.9927, okay? So you just do that. It's really easy. That's the present value interest factor. Right, let me just actually do this. Present value interest factor, and then this present value interest factor, and then payment. Let's do it like that. So the present value interest factor from the table is going to be that. We're going to take the total amount of the loan, and we're going to divide that by the present value interest factor, okay? So the payment annually for this loan is going to be $25,045.71. Now, in this case, just go ahead and click those arrows over here at the top here. We don't need to see the change. When we're dealing with $100,000, I don't care about 71 cents, okay? Besides, if we do it in this Excel sheet, we're going to account for that even though it's not being displayed. So how do we do it using the formula? Well, if you look on the present value interest factor table, it's going to include the formula for you, all right? So I'm going to put it in here, and this is the one we're calculating for it annually. We're just going to take, let's put this in parentheses, 1 minus 1 divided by, in parentheses, 1 plus the interest rate, out of parentheses. This little caret sign right there means raised to the number of periods, out of parentheses again, and then we're dividing all of that by the annual interest rate again. So this, when I hit enter, should be pretty close to what the annual table one is. The table will be rounded. This one will carry out indefinitely as far as it will go. And look at that, we did, okay? So if you want something that's going to be very precise and exact, you're going to want to do the formula method, okay? It's really easy as I just demonstrated. But if you're going to do it where it's more, easy, then do it using the interest factor table. So I'm going to go ahead and open this up to the change, and you can determine whether or not 6 cents is worth it to you, okay? Because that's really what we're off by using the table versus the formula method. All right, but as I was saying, we don't deal with loans in the long or in the annual rates. We usually deal with them personally in the monthly rates. So what we're going to do to make this a monthly thing is we're going to take this annual percentage rate and we're going to divide it by 12. That's going to give us the annual percentage rate for that's going to give us the annual percentage rate on a monthly basis. So basically it's the monthly percentage rate. And then we're going to have to multiply this by 12. Whoops, what did I do? This times 12. That's it. Okay, so we have 60 periods now. Now, you're not going to be able to go find a present value interest factor table that shows you a 0.67% at 60 periods. Just doesn't exist, okay? That's why you have to use the formula when you do this method. But what it's going to do, by me doing that, all I have to do is come up to here, copy this inside it. Don't just click copy and paste. It won't work. But it's going to give us that same exact number, but we're going to click in here, and instead of having to reinvent the wheel, we're just going to drag all of the things that reference the interest to that one, and all the ones that reference the number of periods to that one. Our present value interest factor is going to be something crazy like that, and we're going to divide our annual amount, our total amount of the note payable by that monthly amount, and this is our monthly payment, okay? So this is a little bit more... Sorry, I just dropped my mic. This is going to be a little more reasonable. This is more what we expect to see, all right? So what we're going to do now is we're going to set up this present value interest factor table. We're going to start first with the annual. My chair is sliding weird. So we're going to start with the annual one. So we're going to go ahead and do years. We're going to do the beginning balance. Then we're going to do the interest expense. We're going to do the note payable, payment, and ending balance, okay? Let's go ahead and make this look better than this. What we want to do is we want to wrap the text. We want to center it and make it, look decent that way. Let's do the same thing with this. Years is going to be easy. We're simply going to do 1, 2, 3, 4, and 5. We're going to do the beginning balance. We're going to click equals. We're going to come up here and just select that 100,000. Let me go ahead and fill in these two because these ones are you're going to be doing those with as well. But everything else should be automated at this point. We could change percentages. We could change all kinds of stuff, but it should still work out for us when we do this. Okay, so our interest expense is always going to be our beginning balance multiplied by our interest rate. So we're going to need to lock that interest rate because we're going to go ahead and drag that interest rate down a little bit later on. Our cash payment, we've already calculated that over here. I'm going to stick with the formula method, actually, just so it's a little more accurate. Then we're going to take whatever our cash payment was, subtract out what our interest expense was, and this is the amount that's going to go to our notes payable. And remember, this is going to be a debit. This is going to be a debit. This is your journal entries for each of these years. And, oops, credit. Okay. Our ending balance is going to be our beginning balance minus our note payable. And our beginning balance of the next period will be the ending balance of the current period. So from here, it's just really dragging down these, making sure we did it right. That should be good. Okay, note payable. We're going to be subtracting that out. Cash payment. Now, what we need to do here is we need to just click equals that, and then that will drag down to there. And then our ending balance should be the same there. And as long as you get to 0 here, you've done it correctly. Now, in any situation, if you've done this correctly like this, I can ask you any question I want about this. What's the beginning balance in year 3? 64,545. What is the journal entry in year 4? Well, we're going to debit interest expense. We're going to debit that in year 4 for 3,573. We're going to debit note payable for 21,473, and we're going to credit cash for 25,046. Really simple, because all you're doing is just pulling these 3 numbers from everything we're doing for journal entries, okay? I can ask you year 1, 2, 3, 4, and 5. I can ask you what's the ending balance of year 4, ending balance in year 2. You have this chart. You can answer any question related to anything I could possibly ask you. Now, let's go and take this one step further, all right? We want to know, because we don't deal in annuals, we deal with monthlies. We're the little guy. Oops, we don't want it that way. We don't have annual payments. They just don't exist for us. So we're gonna go 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, and that's gonna represent every month that we have. We're gonna go. This is the number of years. Let's go ahead and make that there. And then, oh wait, let's do this one more time. Okay. Let's do this and make that 2. Good. Now this should get us to 5. Whoops. 48. 60. Yeah, we just got to change that one. Okay. So now we got months and years. And yes, I have one of these for my house that I keep track of, all right? So our beginning balance is still going to be that $100,000. So we're going to reference B2. Our interest expense, however, is going to be a little different. We're going to take this and we're going to multiply it by our new interest rate, which is our monthly rate here. And remember to lock it in. We're going to put that $sign between the C and the 3 because we don't want it to go anywhere else. We want it to stay right where it's at. Let's see that. Okay. Oh, well, we're going to just decrease that. We don't care about that change. Our cash payment, we're going to take our $100,000 and divide that by, oh, we already did that. So it's $2,028. And let's just save us a second of time and reference that. Ending balance is going to be our beginning balance minus our note payable. And our note payable is going to be our cash payment minus our interest expense. So now we are in business. Beginning balance equals this. Let's save us some time because this is going to be a long drag. All right, so we're just going to drag this down. Hopefully when we get to 60, it should be 0. Ah, yes. Let's see if we're like right on kind of a thing. Look at that. I mean, we don't even get to this is great. That's how you do it. It's really that simple. I can't tell you how many people I've had who've had problems with this, who don't do this. This is stuff you're going to do for the chapter, but there's also you got to pick a car out and write up something about with changing the interest rates on this and stuff, how that will impact how much you pay for the car. Let's look at this $100,000 loan really quick, okay? And we can look at it from the annual perspective in this sense because it should be the same. We're going to add up the interest expense here. On a $100,000 loan, you're going to pay $25,000 in interest alone. So to put that in perspective, you basically pay 25% of the loan in interest over the life of this loan. Ridiculously high, 8%. But let's see what happens if we change this up. Now, the annual table thing, this stuff isn't going to change because I looked it up and it's hard coded. And this is why the formula method is preferable, because if I decide I want to do 7%, it's going to change everything for me. What if it's 7 years? It changes everything for me. The only problem is going to be is down here. We're going to have to carry this out, and you can carry this out if you want. Actually, we're going to do it like this. I mean, we can carry this out to as many. Oh, whoops. We needed to do it like this. There we go. I'm sure this will work now. Oh, come off it. Don't be such a baby. All right, we'll do it like this. We'll just take it down to where we went. Okay, there it is. Oh, come on. Let's just do this then. Because I'm taking it double time is why it's not liking it. Come on, go back up. Whatever. Ah, okay, fine. This thing, I'm gonna just zoom out really quick so I can do this easier. Um, oops. Okay. This doesn't like me very much right now. You guys are like laughing at me, I can tell. I can already hear it over the years and airways. Let's unmerge those. There. See, now we got it going up into the right amount. So you can make one of these and drag it out for months. Boom. Okay. So when you start getting into the negatives, obviously that means that the loan isn't that far. I think I changed it to like 7 years. So like in year 7, you should hit 0. Boom, there's 0. Okay. And you can do the same thing over here because we didn't get to the ending balance because of how I changed it there. So you can do the same thing here. Stretch that out to, we can do 30 if you want. They're doing 40-year loans now for homes. It's insane. I pity people that get loans like that. It's just not good. The more you have it, the more it's just bad. So anyway, you can stretch it out to there, and you can see that in year 7 you got to 0. That's the idea. I mean, you can set this up with a bunch of if statements too, so that when you get to 0, it'll make everything else 0. But really, for our purposes in this course, you don't need to do that. If you're ever going to do stuff like this as a real profession, then you might want to do that because it looks really good when you do that, and it just all of a sudden it's 0, and you're like, boom, and everything else has just disappeared. So anyway, that's what you want to do. So you could literally take any amount of money you want. You could take 250,000, 7 years still, you're hitting 0. 12%, 16 years. You really can just play with this and just really see exactly how much you're doing in all this. And it really is a fascinating thing here. You see there's 16 years there, and then there's 16 years there at the end of that year. So anyway, that's the model that I have really loved using over the years for my loans and things like that, because I also do something where I put in an additional interest payment or additional principal payment, because I want to know how much money I'm going to save by doing that, and it's really remarkable. So I recommend it. Anyway, that is your video for chapter 14. I hope you enjoyed it. If you enjoyed it, please smash the like button and remember to subscribe to my channel. I just mess around. It'd be kind of cool though. I think I have like 1 subscriber at the time of making this video. So, but hey, if this stuff helps you when you later on in your career and stuff, who knows? Anyway, I hope you enjoyed it. Take care, and we'll see you guys later.